Hello, listeners, and welcome to another episode of Cognitive Dissidents. As usual, I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Joining me for our weekly rundown on what happened in markets and geopolitics is Rob Larity, our chief investment officer. I won't say much to intro. I will just say that if you haven't rated or reviewed the podcast, please do. And if you want to talk to either me or Rob about Cognitive Investments or this podcast or anything else that perks up your ears in this conversation, you can email me at jacob@cognitive.investments. So without further ado, we'll get to the podcast. Cheers and see you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. Rob, somehow it's been another week since last we talked. How's it going?
Time flies.
Time flies. I was reading an article today in the Asahi Shimbun. I probably butchered that pronunciation. It's a Japanese newspaper. Apparently, there's a guy who ran away from home and lived in a cave until he was like in his 50s. And they did a whole feature article about how he lived in a cave, but then he's the Japanese caveman, but now he's joined normal society. Which is my terrible segue of getting into what happened in markets this week and talking about the Japanese yen. So, from one caveman to another, what's at the top of your list this week?
Well, let's start on the other.
Listeners, he's just blown away by the intrepid skill of that introduction. He didn't see it coming. Neither did you.
We did not prepare that ahead of time, believe it or not. Well, let's start on the other side of the world, and then we'll make our way over to Japan at the end because we want to talk about some China stuff. But in the US, so here's what's happening. Markets are rallying still. We've been talking about this for a while. And the debate going on right now is whether people are being too sanguine about how hawkish the Fed is going to be. So if you look at people out in the marketplace, pundits, investors, interest rate specialists, they're saying that markets are being totally stupid right now, that the Fed is going to be way more hawkish, that they're going to raise rates way more and for longer than the market seems to be implying. That's an interesting argument, and I think that I disagree with that, and certainly at CI we're positioned in a way that disagrees with that, and we have been. And it's an interesting thing to discuss because so much of markets is catching the turns in things, and I think often you see this where, and I've made this mistake plenty of times, where someone has a thesis or you have a thesis, and it's playing out. And then Mr. Market starts telling you, hey, something's changing, something's different. And you want to double down on that thesis and say, well, I rechecked all the numbers. I've gone back to the sources. It still says that it's XYZ. And oftentimes that could be a real pitfall. And I think that that's what's happening here. Because even though the economic data in the last week since we spoke has been quite good, with some modest exceptions, like the service sector index came out yesterday, much stronger than expected. I think people were looking at that to drive interest rates higher and to drive bonds lower in price, and that hasn't really happened. So that presents a problem for the people who think that the markets are just being stupid and they're underestimating the Fed. So the big thing that's going on more thematically across the world is, and we wrote about this in our internal notes, is there's sort of a little bit of mixed message happening and a bit of a battle going on. So while you have that dynamic going on in the US that I just spoke about, so bonds are rallying, bond yields are going down, I mean, stocks are loving it, stocks are rallying, the economic data is better than expected, and yet people are still pricing in, you know, a decline in the hawkishness that we've seen that has been strangling markets. And by the way, a lot of that is just about energy, and energy prices really falling off a cliff, which, remember, at the end of May, we were talking about this, how this was a potential scenario. And the market really likes that. And it's looking at inflation and saying, well, this is peak inflation now. And it's not about the level of inflation, it's about the direction of inflation. So anyway, that's the big dynamic that everyone's focused on. And what that's doing is it's weakening the dollar after this very strong rally that the dollar's had, and that is buoying risk assets across the whole world. So if you look, almost all of the emerging market currencies bottomed around July 15th. And it doesn't matter where you look, the Indian rupee, the Brazilian real, the Thai baht, all of them have moved together. And that's helping a lot of these emerging markets. So like if you look at Brazilian bonds or the credit default swaps on Brazilian sovereign debt, which is a way to insure against default, both of those have rebounded very strongly as the currencies have rebounded. So the dollar weakness has been like a pressure release valve across the world. And you know, the collective emerging market world is sort of unclenching its butt at the moment, if I can use that metaphor.
You can use whatever metaphor you want.
So that's really good, and that's helping risk assets. But the other thing that's going on in the opposite direction is if you go over the sea to China and all the things we spoke about last week, what we said then was we're going to watch this like a hawk to see what happens, to see if they're going to be able to successfully step in and put a circuit breaker into this process. And so far, that doesn't look like it's happening. The most recent data on property sales and things like that have not come out yet. So you really have to watch what Mr. Market is doing to get a sense. And there's a few indicators that I think show that, you know, Beijing is trying to lead the horse to water, but the horse is not drinking. And you mentioned last week about the banker that was interviewed in the Financial Times who said, you know, we're not going to lend to these guys no matter how politically correct it is. That seems to be the dynamic still. And the indicators to watch there are Chinese junk bonds, which have not rebounded. They're just bleeding out, which is a bad sign. That index, by the way, is dominated by these property developers. But the other bigger one is if you look at interest rates in China. So we talked about Shibor here, the Shanghai Interbank Offered Rate, which is essentially the rate to lend reserves within the banking system itself. We spoke about that, how that was going down recently and Hong Kong's was going up, and the interesting tensions that created. Well, what's happened more recently is that Shibor rates are really starting to collapse. And it appears the reason for that is because the PBOC, the People's Bank of China, is trying to inject liquidity into the system to jumpstart credit growth again. And they appear to be pushing on a string to a certain extent. The demand is not there. So they're leading the horse to the water and the horse is not drinking. So you can see this, like if you look at iron ore prices, as I mentioned, most emerging market assets have rebounded strong and all the currencies have rebounded, but iron ore after rebounding is starting to really bleed out again. And, you know, Brazil has looked really good, but if you look at a stock like Vale looks bad and that's bleeding out. So Mr. Market is telling you that the demand is not there. You're not seeing a circuit breaker yet. And that, I think, is a really important thing to watch, because that's a counterweight against all of the positive developments that we're seeing coming out of the other major economic powerhouse of the world, which is the US.
Yes, and then there's well. Before I get to that, I haven't looked at copper yet today. Is copper moving in the same direction as iron ore, or is there any variation?
Copper is a little strange because copper held up much longer than iron ore did, and then it collapsed much more recently. It's since rebounded off the lows, but it's hard to get a real read because that was such a sharp drop. You could just be getting, a reflex rally. So there's not much informational value in copper at the moment.
Missing, I think, though, and they don't want to be left out of the conversation of economic giants, is the European Union. And we are very, very bullish, the European Union. I am getting even more confident about the European Union here. I would love the Europe haters to keep it up. Like, keep talking about how Europe's not going to figure this out. Like, I'm pretty sure they're going to figure it out. There has been some new squabbling between the EU and Poland and Hungary, which, on the one hand, it's not a great time for that. On the other hand, if they're feeling confident enough that they want to take Poland and Hungary to task, that's also a sign that they're feeling pretty bullish. So where does the European Union fit into the picture that you just sketched?
Well, I think that's right. The interesting thing about what's going on in Europe right now is the data is terrible and the markets are liking it, which is interesting. So the German industrial production numbers came out. They were really, really bad, as you can imagine. I mean, all the listeners will know about the energy price spikes and the resultant squeeze. But I think the thing to take away from it is, as we say so often, markets are forward-looking. So this has been so telegraphed, so well understood for so long. The markets are already looking past it, I think. And it's really interesting because even though inflation is accelerating because of the energy issue, so I forget who it was. I think the Netherlands reported their inflation number just today because they're sort of a laggard for whatever reason. And it beat expectations. And, inflation looks bad, very, very bad. And yet, long-term German Bund yields have collapsed along with US yields, which is really interesting because it shows you markets seem to be looking past the inflation issue. And probably more important, European stocks have not made new lows. Mm-hmm. European stocks are not pricing in some catastrophe, which I speculate and I suspect is the market is looking past the winter the winter of discontent. Once it's on the cover of The Economist, it's already, you got to ignore it, right? And I think that was like a month ago already. That was on the cover of The Economist with the little Red Riding Hood in the forest. Which one I'm talking about?
Yeah, I don't want to make a mountain out of a molehill, but there was something I read today in Politico that really struck me, which was they were talking about some of the energy rationing that's starting in the European Union. And they talked about how in Spain, the shopkeepers have to turn their lights off at night, and they're going to restrict air conditioning to 80 degrees. You can't go below 80 degrees, roughly Fahrenheit. And in the winter, they don't want you to heat beyond 66 degrees Fahrenheit. And then the one that really got me was that Germany and the Netherlands and maybe Belgium or something, they've decided they're going to turn off the lights that illuminate the historic buildings in their cities at night. And I stopped there and I was like, hold on, we're in an energy crisis and natural gas prices are X whatever, and we still have the lights on the historic buildings? Like, that's what we're cutting now, 3 months into the crisis? Like, how much of this slack energy can we cut and not really have any true demand construction from the real consumers because the Reichstag doesn't have a light on it? I mean, like, I don't know if I'm probably making too much out of it, but I read that and I was just like, maybe Europe can like cut enough energy here and make it work with LNG imports from wherever else. And it's not going to be this huge calamity. Not to make light of the energy issue. I mean, it's going to be a rough winter, I think, for Europe, especially if temperatures surprise to the downside. But I don't know. That just really struck me this morning.
I think that's right. And Marco made the same point when he was a guest on the podcast a few weeks ago, saying, they're going to be fine. Like, they're going to get through it. And it might even have a subtle positive effect in terms of focusing minds, and not to be callous, but there are potential silver linings to what's going on in terms of bringing Europe together.
Yeah.
I mean, you pointed out yourself, it was pretty striking how quickly they were able to resolve these differences in terms of who's going to ration what and how do you hash that out.
Yeah,
which is a good sign, right?
I still don't understand that as the thunder here crashes in New Orleans. I don't know if you can hear that on the mic.
No, I can.
So somebody upstairs doesn't like that point, I guess. But before the thunder made me lose my train of thought there for a second. What was I about to say? Well, before we turn away, I know what I was about to say. Maybe the thunder was just preemptive. I think it's good that we've made it 15 minutes into the podcast without talking about Taiwan, but it's also probably bad because it's probably the most important thing, or the thing that most people think is important this week. So why don't we do a drive-by of Taiwan, and then maybe get into Japan and the yen and how that intersects with some of these other things. I'm curious what you think about it from your perspective. I thought from a market's perspective, it was fascinating that this big event happened and everybody was scared about it. And my phone was blowing up sort of Russia-Ukraine war style with questions about it. And I'm doing all these interviews. And then Chinese stocks are up at the end of the week. Like everything was fine. You had like one day where there was a swoon, but then despite all of the poor economic data out of China that you were talking about, things actually seemed to be a little bit better. So from your perspective, I mean, did the Taiwan thing make you bat an eyelash at all, or was it just like not that important?
Well, I think the answer is in the meta information here, because this is the first time we've talked about Taiwan. I haven't even bothered to ask you about it all week.
Yeah.
So yeah, I haven't focused on it. It hasn't been something that we've thought about very deeply, or I know you've thought about it very deeply, but it's not something we're taking into great account when we're deciding what to do.
No, I mean, I think we think about Taiwan from a long-term perspective and what that relationship looks like from China in the long term. This is an interesting disjuncture too, though, between geopolitics as applied to investing versus geopolitics as applied to companies. So I still work with a couple companies on a contract basis, helping them think about geopolitics, and they're all freaking out because for them, this means, if China's going to have live fire drills and exercises in the South China Sea, even if there's no war, even if there's no conflict, it's going to disrupt maritime shipping. It can disrupt air traffic. Are the insurers still going to offer insurance for the boats that are going through the South China Sea? I mean, if you're trying to move things from point A to point B, it is something you absolutely have to worry about sort of in the real time. But unless it's going to cause World War III, which I don't think is going to cause World War III, if you're sort of at the investment perspective, as you said, you're sort of going to look through it and say, hey, this is the fourth Taiwan Strait crisis. How did the previous three end? You had a couple months of volatility and uncertainty, and then one side tries to de-escalate, or I should say decides to de-escalate, because it's not going to go anywhere. So I think that's kind of where it is right now. But maybe the listeners, do you think the listeners need to know more than that, or should we just move on to the end?
Well, you tell me. What did you conclude on Taiwan?
I mean, so I would actually, if you listen to this podcast and you're not signed up for the Global Situation Report, here's as natural a time to plug it as I can say, because I analyze the Taiwan Strait crisis really in depth in this week's edition. And I talk about how it's similar and different to the 95-96 crisis. And then I kind of lay out what the scenarios are going forward. And it's a grab bag of scenarios. It's every possible scenario from World War III on down to status quo. And I do think that we're going to have a period here of volatility and uncertainty. I do think that China's going to use the opportunity here to reset what is considered normal between Taiwan and China from a military exercise point of view. Obviously, their level of deterrence didn't work because Pelosi came and visited. So they need to revisit deterrence, and they need to make their threats a little more threatening without going too far and creating a counteraction in Taiwan, which makes Taiwan want more independence or doubles down U.S. support of Taiwan going forward. So I think China has to thread a very difficult needle there foreign policy-wise, but that their response has actually been fairly proportional to how they responded previously. And that, as you point out, I mean, they have bigger fish to fry right now. Like, they are worried about the domestic economy. I think that's where the main focus is in China, and the rest of this is somewhat a distraction. I recorded a podcast with Jordi Visser this morning, which is going out in about a week and a half, and he also made a good point about the Taiwan issue in relation to the real estate crisis, which is, in China, if you're a Chinese real estate buyer, you've got these COVID-19 lockdowns that seem to come and go as Beijing pleases. And now you've got this Taiwan crisis. So aside from all the different problems that you have in China, why are you supposed to be thinking long-term and making real estate purchases right now if you have all of this uncertainty? So I think it actually behooves China they have to make their stand and make their show, but then I think they want to calm things down and get back to the economy. But that was a mistake I made in the Russia-Ukraine war. I underestimated what Russia was willing to do and what it was willing to tolerate. So I'm also, in the back of my head, conscious of not making that same mistake when thinking about China.
Well, a quick observation about that. I think you're making a classic analytical error that we talk about all the time as analysts within the investment team, which is you've been burned by a trade and now you're too shy about the trade.
Well, I'm not shy. I'm just aware that I could be wrong. Like, I'm still sticking to my guns. I don't think anything's going to happen. But like, I did say this. Like, it was a very similar model for Russia, Ukraine, and it didn't work. So
that's true. That's true. But I do think that is the one thing from an investment standpoint that I do think about, which is, as Jordi pointed out, this isn't good for the other problems that they're dealing with. It's only bad. And as I talked about before, the really hard thing about what we do, and this is a theme that we keep coming back to in these conversations, I think we talked about it in the context of coffee a few weeks ago, and how commodities are naturally mean reverting markets, and things like inflation and interest rates sow the seeds of their own, the demise of trends. And I think the way that applies in the Chinese context here is, as I said, they've led the horse to the water and the horse is not drinking. And I think what gives me pause, why I don't immediately look at the Shibor interest rates and Chinese junk bonds, crapping the bed and say, oh, well, let's go short volley and short iron ore, and this whole thing is falling apart, is just the realization that development alone creates its own effects. And if the horse is not drinking when they lead him to the water, they may take a fire hose and shove it down the horse's throat. So that's the tricky thing, is you really have to look several steps in advance and try to understand what is the reaction function, what is the most likely outcome. And that's not easy, which is why we're not really doing anything. As I said, we're just watching it like a hawk. Mm-hmm. But it's premature to conclude that what Mr. Market is telling us right now about the lack of demand, the lack of the circuit breaker coming into effect, that's going to remain that way, especially after the events of the last week.
Yeah. Speaking from personal experience, unfortunately, the thing about trying to force horses to do something is that they can kick you in the face. So I'm sure the Chinese are aware of that as well. I'm sure there's a pithy Chinese proverb for that is just not in my toolkit, but there you go. The hills are high, but the horse kicks in the face. Let's move on there. You mentioned about energy. It's been remarkable, I think, to watch the narrative change on energy from 2 to 3 months ago, when everybody was, wow, oil, 300 a barrel, everybody thinking, prices were about to go to the moon. And I feel like this was the week where the narrative shifted to real bearishness, because now I'm seeing like, oh, it could be 70, it could be 60. Like, people who are trying to be edgy are now kind of going on the downside. It's a much less talked about and much more niche topic, but one that we like a lot. I feel like there was a similar amount of confidence in what was happening with the yen. everybody was talking about the yen is going to weaken, the yen is going to weaken, the Fed is going to raise interest rates. And the yen weakened. It crashed through some pretty important milestones, but then it found support and it's been turning around. And despite even more Fed hikes, seems to be sort of making a bit of a comeback. So I'll tee that up for you and ask you to take us through the yen and why you decided to double down on the yen coming back from the dead.
Yeah, well, this is a good opportunity to plug our Twitter account because Tom has been doing a great job of taking our internal notes on our knowledge platform and taking snippets of that and sharing it online. So if you're interested in what we talk about and you like to see the charts around some of the market aspects of what we discuss, you should go follow us on Twitter, which is Cognitive Invest, I think, at Cognitive Invest.
Yes.
So we were talking about the yen about 10 days ago in this context. So the thing that's interesting about the yen and the broader lesson here, which I think is interesting, is this is one of those classic setups where people think it's a no-lose trade. And the setup going into this was Japan has rates, nailed to the floor, and they have forever. They are the OG QT guys. And the rising U.S. interest rates, were just exerting more and more pressure on the, the Bank of Japan to abandon that policy because the interest rate differential just got way too wide. And that seemed like a no-lose trade to a lot of people because inflation was going up. Interest rates were going up in the US. The Fed was talking about how hawkish they are. As we just discussed before, the people who focus on interest rates, they're all hawkish right now. So their assumption is, hey, rates could go to 5% before this is over. And what is the Bank of Japan going to do then? And those are always interesting setups because when you have something, we've talked about in the past, the notion of investment committees and things seeming logically so airtight and so nice where you could explain it to someone and they say, oh, well, that sounds great. Let's do it. And I think this is one of those cases because it has not turned out really the way that most investors think. And I say most investors because the level of speculation or speculative futures positioning when the yen was, in the high 130s was very high, and it's still extremely elevated, which is why I think you're likely to get a big, sharp move in the opposite direction because there's just so much money that's piled in on the other side of that trade. There's something about something being too good to be true or too easy to be true, and I think that was the case here. And what you're seeing now is the reason why the yen is starting to really strengthen, or dollar yen. If you look at a chart, usually it's shown as dollar yen. So in this case, the dollar is collapsing against the yen. Is that, the same narrative that we spoke about before. The market is looking past the inflation. It's looking past these interest rate expectations. And at the farther end of the curve, it's assuming a more normalized environment. So in that Twitter thread that we put on there, we pointed out, the yen has moved in absolute complete lockstep with the 10-year US Treasury yield. And that has really broken down, and the yen has started to follow it with a vengeance. So that's the dynamic that's playing out. And I think, we've been in this, and just by the time this gets published, we're going to be in it in a more significant way again on this little rebound in the dollar. But that is, I think, has the potential to really just rip in the opposite direction. The interesting thing about the yen too is China has been in a slowdown. They've really, demand coming out of China has been weak for all the reasons that we've talked about. I kind of like the risk reward there, where if indeed, like you have this dynamic I just described, pushing the yen up again, but if indeed you have, China rebounding in terms of fixed asset investment growth, they put the circuit breaker in, that's going to be a bolus for Japanese economic growth. And the interest rate differential is going to be less of an issue.
The other part of this, of course, is also if energy prices go down, also good for Japan. I mean, like if people were wrong about their expectations on the oil prices, that's music to Japan's ear, since they import basically 100% of everything that they consume from an oil point of view and a natural gas point of view, for that matter.
Yeah, totally correct.
Anything else to say about Japan before we move on, or did we hit it?
No, I think we hit it.
Okay. I thought we'd close out the last part of the podcast talking about something you raised before, which was we didn't talk that much about the U.S. stimulus, Manchin Cinema Inflation Reduction Act, whatever euphemism they decided to put on it. But you've been thinking about it in the context of energy as well, and wanted to talk a little bit about nuclear and coal and the relationship between them. So I'll let you open it up, and then we can go back and forth on that a little bit.
Sure. Well, last week when we were talking about this, you asked if I had had a chance to read the bill, and at that point I hadn't gotten through it. But I have spent the last week thinking about this, whereas I spent the prior week thinking about China mostly. And one thing that I came across, and this is fairly nascent, and part of the reason why I bring this up is I'm curious if any listeners know about this issue and want to contact us and educate us. I would love that, because I'm just studying this now. But the potential opportunity that I'm looking at is, everyone is bullish on uranium. And that's been a story that's been around for a long time. I almost feel like the uranium bugs have replaced the gold bugs in the online discussion, because the gold bugs, it's kind of old hat now. It's a lot of those guys have moved over to uranium, I think. But uranium prices have done well, and uranium miners have done very well. And I just don't think that if you're bullish on nuclear long term and you have a time horizon that's beyond the tactical, that's necessarily the best way to play this at this point. So if you look at a company like Cameco, which is the biggest uranium miner in the world, they trade at 7 times sales today for a deep cyclical mining company. That's awfully rich. And if you look, that's where it traded in like 2006, right before the stock went down 75% and proceeded to stay there, which isn't to say that that's going to happen today. But, uranium mining is a deeply cyclical, asset intensive business. And mining just over the long term is tough to really make money as an investor or as a miner yourself. So that's a long-winded way of saying, what are other potential ways to get exposure to this? And one thing that I've been looking at is the notion of using coal power plants and repurposing them as small modular reactor nuclear plants. And so the interesting aspect of that, I bring this up because in the bill that has been proposed, they're going to extend something like $7 billion to extend the life of existing nuclear plants. So there's a push to promote this. There's a renewed energy and optimism. And the thing that's interesting about this is, operationally, if you take a coal plant, my understanding is a large proportion of all the infrastructure around that coal plant can be repurposed for a small modular reactor. So we're talking about, the access to the water, the connections to the grid, all of the sort of environmental machinery and you know, the stuff on site other than the actual, you know, generation equipment. And you also have a local workforce that's working at the coal plant and has probably been wringing its hands about what it's going to do when the coal plant shuts down. Because if you look at all these utilities that own these coal assets, they've been an albatross around their neck. The utilization rates have been falling as they've been pushed to drop them. In some cases, some states have mandatory caps on the utilization rate. So these are not productive assets, but they have, you know, full workforces attached. So from an operational standpoint, it's a really interesting opportunity because so much of the cost burden of building out one of these things, especially in, you know, the age of NIMBYism and in the current environment, and this is something we talk about all the time, where it's just really difficult and really expensive to build stuff, to build physical stuff. The NIMBY theme, which we see crop up all over the place, that's a really interesting backdoor into doing that in a very cheap way and a very politically palatable way. Because you don't have NIMBYism if you've already got a coal power plant there. That's, you know, that's not an issue anymore.
Well, don't underestimate NIMBYism, but I've been thinking a lot about this from another angle, which I would ask you about, though, which is that, I mean, I don't quite understand why, from a psychology perspective, we got to the point with nuclear in the United States where we are right this second. Because nuclear seems to be an answer to all of the questions that people are having about hydrocarbons. Like, it's cleaner, it's better, it's like it seems to be great on a lot of different levels. And something seemed to happen in the United States in the 1980s or so, where people just got scared away from nuclear. And I can't believe that it was just the accident at 3 Mile and Chernobyl or something like that. But there is still so much skepticism about nuclear and so much pearl clutching that happens when it comes up that I don't quite understand. Like, one of the charts that I always show audiences when I talk to them is the amount of new nuclear capacity that's coming online in the next 10 years. It's all India and it's all China. Nobody in the developed world is really building new nuclear plants. And to do that, you really do have to fire it up. So, I mean, that's separate from what you're talking about, because there's a whole, you know, using the current infrastructure, coal into nuclear plants, and let's use natural gas pipelines and do hydrogen. Like, that sounds like a beautiful future I'd like to live in. But I wonder if there's a political... Do you have a sense of why people are so skeptical of nuclear and how we even got to this point in the first place, when the solution might have just been staring us in the face the whole time?
I don't know if I have anything new to contribute to that analysis other than pointing out it's not just in the United States. If you go to France, which ironically has almost 70% of its electricity generation coming from nuclear, the left is extremely anti-nuclear. The Greens are traditionally anti-nuclear. And my speculation would be that it's primarily because people like the idea of wind. They like the idea of solar power. Like, it feels like that's natural. And if you're not actually analyzing the numbers, which who analyzes the numbers? It's all about, you know, this is a political issue and politics is about emotion. Then it's very easy to overstate the potential, you know, deployments and the potential impact of wind and solar, and to crap all over nuclear.
Yeah. Well, I asked that question because, like, what you're saying to me makes total sense. But I feel like it's going to face two significant political challenges. It's going to face challenge from the left, because the left generally doesn't think of nuclear as a renewable or as the type of thing that you want to shift into and use these hard-fought dollars for. The coal miners aren't going to like it, because just because you work in a coal mine doesn't mean you can work in a small modular nuclear facility. And anyway, you're going to become more relevant. They want to make more coal. They want to sell coal to all these countries in Asia that want to import coal. So I just wonder, it's a very elegant solution, but I wonder if it's going to crash against some political constraints that just aren't going to let it move forward. But maybe the bill is a signal that people's minds are changing, and that this Russia-Ukraine crisis has the ability to shake the cobwebs out of people's minds.
Well, I don't know. And this is why I'm particularly intrigued by this idea, because I don't think the left in the US is so anti-nuclear as we might think if it's being built in place of a coal power plant, which is the devil. So, and most of these coal power plants are not located in blue states. Like if you look, the analysis I was doing today, I was looking at Virginia, because Virginia is where all the data centers are getting built. And companies like Google and Microsoft that run cloud infrastructure as a service data centers want to have green energy going into those data centers, but they can't have intermittent green energy. They need a steady source of baseload green power, which is intriguing because in Virginia, because it's close to where the coal is, there's a lot of coal power generation capacity. So that's a potentially big option that they're already looking at. There's an interesting webinar. I shouldn't say interesting because it's super long and boring. It's like 2 hours. It's a bunch of academics who don't know that like real people are actually watching them. But I spent a good amount of time just this morning watching an IAEA 2.5 hour webinar where the interesting thing was all of these people from Electricité de France. There was someone from Terraform Power, the Bill Gates backed group. There was someone from the UK, and they were all talking about specific case studies where they were actually doing this. So this Terraform Power is building one of these things in one. I think it's Pacific Core is the name of the utility. It's owned by Berkshire Hathaway in the upper Northwest. But they have the largest fleet of shuttered coal power plants or nearly shuttered coal power plants. And EDF was saying, well, we're exploring doing this in this place here, and we have experience with nuclear and what kind of skills are involved in managing these plants, and we think that this is doable. They're looking at case studies of this in Romania. Like it's a real thing. And the thing I find interesting about this, just to bring it back to investing, like those are all fundamental things, is the uranium thing. Okay, like fine. That's going to do well or not do well, and it's going to be very cyclical, and it's something that's well understood and well studied. I don't really like the risk reward of trying to time that, but what I find so intriguing about this is if you think about like the enterprise value of a coal power plant, right now it's extremely negative because the implied liabilities tied to that power plant are going to be huge, because all of these things have an end date that's in many cases been pushed up, and you have to incur a huge liability to close them down, to do the proper environmental remediation. All of this stuff is very expensive. So these albatrosses are sitting on the balance sheets of some of these utilities at a negative value. And just think, what if you have an opportunity to repurpose that asset and all of that stranded infrastructure can be turned into positive value infrastructure that's contributing to a new productive asset? Well, then when you think about stocks and sort of value and risk reward, like if you're buying a miner, what is your starting point, right? 7 times sales in the case of Cameco. In this case, like obviously you couldn't just buy a coal power plant. You have to buy it through the vehicle of a utility. But you're going from something that's a deep net negative to now you're positive.
What would stop a company like Google from buying coal? Could they do that, like if they wanted to?
From buying coal electricity, you mean?
No, I mean from buying the plants themselves. Like, does the utility have to own it, or could one of these big tech companies, if they see what you're talking about and they want to have and they want to transition these these decrepit coal shuttered power plants into, little thermal or not thermal, into little module nuclear. Like, could some of these very rich tech companies just buy up the real estate or buy up the shuttered coal plants? Or I don't know if you got that far in your research, whether there's restrictions from an environmental or regulatory standpoint on their sale.
Well, I think there'd be a pretty high hurdle to do that, because I don't understand the potential issues around if something is on the grid and is providing public electricity. If you repurpose that asset, do you have to continue to make it available to the public grid? I don't know. I'm not a utility expert. I'm just a generalist guy trying to figure stuff out. So that could be a potential issue, because it's possible that they would have to become, regulated like utilities, or set up a subsidiary company that is subject to the PUC and stuff, and that's a real pain in the ass. But maybe if they wanted to build a data center right nearby one of these things, it could make sense. I don't know.
And did you get as far as how much it would cost to do this?
I have not gotten that far yet.
Yeah, I wonder if that has something to do with it too. All right. Well, something we'll be thinking about. And listeners, if any of you out there have insights to make us sound smarter the next time we talk about this, please let us know. We're looking for it. What else, Rob? We're at 45 minutes. Is there anything else on your mind, geopolitically or markets-wise in the world, or do we give the listeners back a little bit of their time today?
I think given the length of our China discussion, we'll keep it short and sweet.
Short and sweet. Okay. Well, listeners, Rob at cognitive.investments or Jacob at cognitive.investments, send us your feedback, your book recommendations, and your wisdom about turning coal plants into nuclear power plants. And other than that, we will see you next week. Cheers.
Take care.
Thank you so much for listening to the Cognitive Dissidents podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.